Past 28. Investments in associates and joint ventures. Past 28 prescribes the accounting for investments in associates and the application of the equity method to investments in associates and joint ventures. Investors apply Past 28 when they have significant influence or joint control over an investee. Investment in associates. What is an associate? An associate is an entity over which the investor has significant influence. The existence of significant influence distinguishes an investment in associate from all other types of investments. Dahil sa significant influence, malalaman natin kung saang type ng investment nakapaloob ang isang investment. There are 4 types of investment. First, investment measured at fair value. Second, investment in associate. Third, investment in subsidiary. And fourth, investment in joint venture. But we will only be discussing Past 28, which is investment in associate. What is a significant influence? It is the power to participate in the financial and operating policy decisions of the investee, but it is not control or joint control of those policies. It is presumed to exist if the investor holds directly or indirectly 20% or more of the voting power of the investee, and vice versa. Means kung ang hawak mo lang na voting power ay less than 20%, it is presumed that significant value is not existing. But these are only presumptions. They are held to be true in the absence of evidence to the contrary. Any of the following will provide evidence of the existence of significant influence. First, representation of the board of directors or equivalent governing body of the investee. Second, participation in policy-making processes, including participation in decisions about dividends or other. Third, material transactions between the entity and its investee. Fourth, interchange of managerial personnel. And fifth, provision of essential technical information. If you only have less than 20% of ownership of interest, ito ay financial asset at fair value. Kung meron kang 20 to 50%, ang type na investment nito ay investment in associate and meron nitong significant influence. Kung meron kang 51 to 100% na ownership ng interest, ito ay isang investment in subsidiary. And contractually agreed sharing of control, it is investment in joint venture. Accounting for investment in associates. Investment in associate are accounted for using the equity method. Under the equity method, the investment is initially recognized at cost and subsequently adjusted for the investor's share in the investee's changes in equity. Example, profit or loss, dividends, and other comprehensive income. Share in associates, profit or loss. Ang sabi dito ay meron itong increase na epekto sa investment in associate at meron ding increase effect on investment in income. Ang dividends naman ay may decrease na epekto sa investment in associate at wala naman itong epekto sa investment in income. At ang other comprehensive income naman ay may increase na effect sa investment in associate at wala ring effect na mangyayari on investment in income.
January 1, 2021, Entity A acquires 20% interest in Entity B for 400,000. Entity B reports profit of 100,000 and declares dividend of 50,000 in 2021. The 20% of 400,000 is 20,000. The carrying amount of the investment in associate on December 31, 2021 is computed as The investment is initially measured at cost of 400,000. Entity A acquires 20% interest in Entity B for 400,000. 400,000 times 20% is equal to 20,000 and declares the dividends of 50,000. The 20% of 50,000 is 10,000.
Investment in associate is an asset. It has a normal debit balance. The beginning balance is placed on the debit side of the T account. The ending balance is placed on the opposite side. Investments in associates are presented as non-current assets. Application of the equity method. An investor starts using the equity method as from the date when it obtains significant influence or joint control over an investee. On acquisition, the difference between the cost of the investment and the entity's share in the net fair value of the investee's identifiable assets and liabilities is accounted for as follows. If cost is greater than the fair value of the interest acquired, the excess is goodwill. If the cost is less than the fair value of the interest acquired, the deficiency is included as income in determining the entity's share in the investee's profit or loss in the period of acquisition. Any resulting goodwill is included in the carrying amount of the investment and is not accounted for separately, meaning the goodwill is neither amortized nor tested for impairment separately. Adjustments are subsequently made on the entity's share in the investee's profit or loss to account for the depreciation or amortization of any undervaluation or overvaluation in the investee's identifiable assets and liabilities. Investment in associate is an asset. It has a normal debit balance. The beginning balance is placed on the debit side of the T account. The ending balance is placed on the opposite side. Investments in associates are presented as non-current assets. Application of the equity method. An investor starts using the equity method as from the date when it obtains significant influence or joint control over an investee. On acquisition, the difference between the cost of the investment and the entity's share in the net fair value of the investee's identifiable assets and liabilities is accounted for as follows. If cost is greater than the fair value of the interest acquired, the excess is goodwill. If the cost is less than the fair value of the interest acquired, the deficiency is included as income in determining the entity's share in the investee's profit or loss in the period of acquisition.
If the investee if the investee has outstanding cumulative preference shares and classified as entity, the investor computes its shares of profit or losses after deducting 1 year dividends on those shares, whether declared or not. The investor shares only up to the amount of the interest in the associate or joint venture. Shares in losses are applied first to the carrying amount of the investment in associate or joint ventures. Zeroed out. After the total balance of the interest is zeroed out, the investor stops sharing in the further losses, except to the extent that the investor has incurred legal or constructive obligation, made payments on behalf of the associate. Investments in associates or joint ventures that are classified as held for sale in accordance with the PFRS 5 are accounted for using that standard. If only a portion of the investment is held for sale, the remaining portion will be using the equity method. An entity stops using the equity method as from the date when it loses significant influence or joint control over the investees. If the investment becomes a subsidiary, it is accounted to use the PFRS 3 business combination and PFRS 10 consolidated financial statements. If the investment becomes a regular investment, it is accounted to use the PFRS 9 financial instrument. If an investment in associate becomes investment in joint venture or vice versa, the entity will continue to apply the entity method. When the equity method is discontinued, all previously recognized amount in the other comprehensive income are either reclassified to profit or loss as reclassification adjustments or transferred directly to retained earnings using the provision of PFRS. The investor uses PFRS 11 joint arrangements to determine whether it is interest in a joint arrangement is an investment in joint venture. Associate is an entity over the investor has significant influence. Significant influence is presumed to exist when ownership interest is 20% or more. Under the equity method, the investment in an associate or joint venture is initially recognized at cost. When an associate has cumulative preference shares, the investors computes for its shares in profit or loss after deducting one-year dividends. The application of the equity method starts when significant influence or joint control is obtained and stops when significant influence or joint control is lost. Share in losses of associate or joint venture is recognized only up to the amount of the interest in the associate or joint venture. When an associate has cumulative preference shares, the investor computes for its shares in profit or loss after deducting one-year dividends.